Welcome to our 2022 webinar series, Risk Management with Insurance in a Post-Pandemic World. The COVID-19 pandemic taught us to adapt and accelerate trends socially, technically, and environmentally. As we inch into the post-pandemic world, risk management continues to be top of mind for most of us. Each month, you'll learn about insurance solutions you and your clients can consider, plus the significant impact to insurers and their post-pandemic strategies. Each webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer all questions at the end of the presentation. Today's webinar is being recorded and will be posted on our website within 24 hours. Today's presenter has been part of LLIS since 2009. She handles many of your clients' cases for life, disability, long-term care insurance, and annuities. Since 2014, she's been supervising our very busy new business team. She earned her FLMI designation in 2016, passed her Series 6 in 2020, and recently received her AALU designation. Here to present on life insurance underwriting is Jennifer Stiles.
Thank you, Claudia. Today we're going to talk about underwriting challenges and the best practices for life insurance. We'll go over underwriting and talk about the basics of underwriting, but we'll also go over technology's role in underwriting. And we'll talk about the differences between full underwriting, accelerated underwriting, and automated underwriting. But before we go into that, let's talk about the basics of underwriting. What is underwriting? And there have been a lot of changes in underwriting in the past year. Underwriting is actually assessing and classifying the degree of risk an insured represents to the insurance company. The underwriter reviews a lot of information about the client and decides whether to accept or decline that risk. Obviously, the higher the risk, the higher the premium. Now, when it comes to underwriting approvals, I like to think of them as buckets. There are predetermined conditions you must meet in order to fit into that bucket, and there's predetermined premiums associated with those buckets, and that's what allows us to accurately quote different companies. Now, Preferred Plus, Preferred, and Standard Plus, all three of these are considered preferred classifications. It's important to understand that all three of these approvals are people that actually have longer than average life expectancy. Now, standard approval, that's what most people are approved at. That is actually average life expectancy. So anybody who receives a standard approval or better, those are all very good offers. I know we all want Preferred Plus, just like we all want an A+ on a test, but we're not all eligible for that. In fact, very few people are actually eligible for Preferred Plus rates. Now, clients that may be slightly higher risk to the insurance company may be table rated. And depending on the insurance company, there's anywhere from 10 to 15 table ratings. And they'll go like table A, B, C, or table 1, 2, 3, depending on the company. And each table rating is 25% higher premium than the standard premium. So if a particular company, their standard premium is $1,000 a year, if that person was approved at table A or table 1, it would be 25% higher. So their total premium would be $1,250. If they were approved at table B, it would be 50% higher. So it would be $1,500, and so on. And that's the way every single insurance company does it for life insurance. Some do it based upon the Standard Plus premium. Others do it based upon the standard premium. And the reason why there's a difference between, some doing it Standard Plus versus standard is not all insurance companies actually offer Standard Plus category. Some go Preferred Plus, Preferred, and straight to Standard. And so that's why there's a difference, but they all do it on that 25% increment. And then every once in a while, we'll see a flat extra. We see this if somebody does a hazardous activity or maybe they've had cancer in the past. And we'll go over an example of that later on in the webinar. Now, within these buckets, there's male and female rates. Everything else being equal, women are going to pay less for life insurance because we tend to live longer than men. So we're going to pay less for life insurance, but we actually pay a lot more for disability and long-term care insurance. And then there's also smoker and non-smoker rates. So smoker rates for life insurance tend to be about 3 times the non-smoker version or non-nicotine version, okay? For disability or long-term care, it may be about 25% higher premium, but life insurance, it makes a huge difference. Now let's talk about what the underwriter is going to review. Now, underwriting typically takes about 2 to 3 months before you get an approval. Of course, there are some accelerated processes that go much quicker, and we'll go over that later on in the webinar, but typically it takes about 2 to 3 months. And what the underwriter is going to review is the application, the exam, they'll order your motor vehicle report, they'll run your name through the Medical Information Bureau, the prescription database, they'll order medical records, they'll review financial information, and information from a phone interview that you may do with the insurance company. And like I said, very few people may be eligible for that preferred plus. I mean, people may say, Jenny, I'm super healthy. I want that preferred plus rate. And your health does actually have a lot to do with that final approval. But when you go through underwriting, there's actually 4 areas of underwriting. They take a look at your lifestyle, medical history, of course, financial information, and family history. All of this, plays into your final approval, and we'll go into more detail with each one of these. So let's dive into, lifestyle. What do we mean by lifestyle? Well, they're going to take a look at any hazardous activities you may do, any marijuana, drug, and alcohol usage. They order your driving record, and they look at any sort of foreign travel. So let's take a look at hazardous activities and some examples of that. There's certain sports or hobbies you may participate in that can carry an increased risk of injury or death. And an underwriter needs to become familiar with these risks and know how to appropriately assess those. And some of the common examples of hazardous activities may be aviation. And we're not talking a pilot of a commercial airline. Those planes pretty much fly themselves, but we're looking more like a student pilot or private pilot. But mountaineering, scuba diving, race car driving. And it's important to understand just because you participate in one of these type of activities does not mean that you're going to be declined for insurance. All it means is that the underwriter needs to take a closer look. We actually have questionnaires for each one of these activities. So for scuba diving, if somebody says, yeah, I do some scuba diving, we'll send a questionnaire asking questions like, okay, are you a certified diver? How deep do you dive? How many dives have you done in the past 12 months? How many do you anticipate doing in the next 12 months? Do you do night diving or cave diving? So no pun intended, we need to, quote, dive deeper into that activity and ask some more detailed questions. So let's take a look at a situation here. Which one is at higher risk? Me, who went skydiving once because it was on my bucket list. Not the most attractive picture of me, but it was fun, right? Or my friend Dave, who does extreme skydiving. He's part of the X Games, does activities such as that. Now, you may say me because I'm inexperienced, but I'm actually strapped to somebody who's experienced. I don't plan on doing it again. And even if I did, that's okay. Dave is doing, 40 dives a month. He's doing tricks in the air. He's at much higher risk than I am of dying from skydiving. Okay. Um, Not only that, actually, he doesn't do skydiving anymore. Once he got married and had a couple kids, his wife actually said, "It's not us skydiving anymore. We have to think of our kids now." So she actually kind of made him stop those activities. And now he does race car driving. So somebody who does extreme skydiving like that is an adrenaline junkie and is probably taking other risks in their lives as well. But nonetheless, what an insurance company, if Dave were applying for insurance, and this is not a case study, but if he were applying for insurance, what an insurance company may do in his situation is either put an exclusion or a rating on the policy. We don't see exclusions too much with life insurance. We see it a lot with disability, but they do put it in situations such as this. So say Dave was applying for insurance, $1 million, 20-year term. He's healthy, right? So maybe he would be approved at Preferred Plus, and the insurance company would put a skydiving exclusion on the policy, and his premium may be, potentially $900 a year. And Dave may say, "Jenny, wait, I know I'm healthy. What I'm concerned about dying from is actually skydiving. So I want them to cover that." So the insurance company's like, "Oh, so you want us to take the risk?" Well, in that case, if you want skydiving covered, we're going to need to tack on an extra $8 per thousand of coverage. So since Dave is applying for $1 million, that's 1,000 thousands, right? So they're going to need to tack on an extra $8,000 in addition to his $900. It seems like a lot of money, but he has options here. You have skydiving excluded, you pay $900 a year, or if you want it covered, which the insurance company is at a much higher risk, right? You pay the $8,900 a year. So let's talk about marijuana, because this is one of our, funnest topics here at LLIS. Before COVID, this was the quickest changing thing in underwriting. Since marijuana has been approved in so many states for recreational use and just about every state for medicinal use, there have been a lot of changes in underwriting of this drug. So in order to make an assessment, we need to know the following questions. How often somebody uses the marijuana? How much? What form? Now, not to date myself, but when I was in college, you only smoked it, and it was in a bong, pipe, or joint. Now it comes in brownies and gummies and drops and lotions and vape, and you name it, it comes in that form. So we need to know what form the person is using, the last time they used it, and whether they're using it recreationally or medicinally. And if they do have a prescription for it, we need to know, what medical condition that they're treating for that. And based upon these answers, they could be approved at Preferred Plus to decline, depending on the insurance company and what their answers are. And interestingly, it doesn't matter what state you live in. They're not going to say, "Oh, you live in Colorado and you're using it recreationally and it's legal there, no problem." But at the same time, they're not going to penalize me, living in Florida, and I may use it recreationally and it's not legal here. And the reason being, it's still against federal law, so everybody's underwritten the same way. So let's go over a case study on how quickly this situation has changed in the past couple of years. Here we have Joey, age 40, applying for $1 million 20-year term. He filled out the quote request, right? And or maybe his financial advisor did. I'm not quite sure. But we originally quoted him Preferred Plus. And you can see here, American General is the least expensive company for him. But those of you that have worked with us before, you know, after the initial quote, we ask additional questions and we do our own brief phone interview. Well, during that phone interview, we found out that actually Joey likes to partake in marijuana. He smokes or uses edibles 2 times per week or less. You know, he's not using it on a daily basis. He lives in Colorado, but like I said, it doesn't matter what state you live in. So just based upon that marijuana usage, we had to revise quotes. You could see that difference just based upon the marijuana. Some of the companies would consider Joey table rated. Some would consider him a smoker, and American General would consider him table rated and a smoker. And that's why the huge increase in premium. American General would have actually been the worst company to apply with. Clearly, we had him apply with Lincoln, and he was approved at that rate. Now, in 2021, I noticed that the insurance companies seem to be becoming lenient, or more lenient anyway, with marijuana usage. So I went back to these same 6 companies with Joey's scenario and said, how would you approve Joey, you know, or somebody who's age 40, you know, using marijuana twice a week or less? And this is what they came back with as far as the premiums. So as you could see, American General became very relaxed with marijuana usage compared to the year before. I think when marijuana first became legal recreationally, there wasn't a lot of data out there about the effects and, you know, as far as longevity. And insurance companies were being very cautious maybe in their quoting and their approvals when it came to marijuana usage. And now they've become a little more relaxed with that. So that was a big change in the past couple of years. When you apply for insurance, they order your motor vehicle report. Now, no insurance company cares if you've had one speeding ticket in the past 5 years, but if you've had multiple tickets, at-fault accidents, any DUIs or driver's license suspensions, that can definitely affect your final approval for life insurance. And then they also ask about foreign travel. We've always asked about that pre-COVID, and it definitely became a challenge during the pandemic. And typically what we need to know is where you're going, how long you're staying, and the purpose of your travel. Obviously, somebody going to London for a week-long vacation versus somebody going to Botswana to volunteer in a village for a mission trip may be looked at differently. There could be health concerns for the Botswana trip. Do you have access to clean water? What's the sanitation like there? If you were to get sick, what's the health care like there? And you could be exposed to other diseases that you're not typically exposed to, like malaria or yellow fever. There could also be safety concerns. Maybe there's some civil unrest at that particular location. Now, most insurance companies are fine with level 1 or 2 from the State Department. So level 1 is exercise normal precautions. Whenever you do any sort of foreign travel, there's a certain level of precaution you should take. Level 2 is exercise increased caution. Maybe there's a little bit of crime in the country there. Level 3 is reconsider travel. And level 4 is do not travel. Well, the pandemic hits and every country in the world becomes level 4. I'm not even sure when the pandemic hit that you could do any foreign travel. I think the airlines were shut down the first several weeks when it came to foreign travel. But, you know, several weeks or months after that, they started flying to other countries. We didn't see a lot of people flying for pleasure, but some business travel. You know, we did have some clients that were doing business travel. And what the insurance companies were doing is they were postponing making any offers until the client was back in the United States and they were back here for at least, depending on the company, 2 to 4 weeks. So we would have to wait that time frame before we could submit an application to the insurance company. That postponement actually lasted up until about 8 months ago, maybe 10 months ago, way past the vaccination. So even after, the vaccination rolled out, insurance companies were still postponing making offers, if people had booked foreign travel. Now, just about every insurance company is fine with foreign travel. They've all gone back to the regular State Department levels for kind of the more civil unrest. So, obviously, right now you can't go to Ukraine. But if somebody wants to go to London or the Bahamas, every insurance company is fine with that now. So that's lifestyle underwriting. And there's other examples as well, but that gives you, a little taste of what they look at. Let's take a look at medical underwriting, because that's what most people think, really goes into the underwriting for life insurance. And that is a big part of it. So typically when you apply for insurance, you have an exam done. And what they're looking for is organ damage. So you have blood tests where they're doing looking for liver function test, kidney function test, HIV. They'll test your cholesterol. They'll do urinalysis where they'll test for nicotine and drugs. An examiner will do your blood pressure, height, and weight. Now, the tricky thing was when the pandemic hit, all insurance companies, and we did as well, saw a huge increase in business. It's probably all your 30-year-old clients that were thinking, oh, I don't really need this insurance. I'm young and healthy. All of a sudden realized, geez, that $1 million of life insurance that my financial advisor was saying I should get, maybe I should get that. So we all saw a huge increase in business. But like I said, insurance companies need to have an exam done, right, on the clients. That's part of underwriting. But it made it tricky because with the CDC's guidelines of, social distancing, clients were not a fan of having an examiner come into their home to take blood and urine when they were just in somebody else's home. They could be potentially exposing them to COVID, right? So, people wanted to have this insurance, but at the same time had that concern. Now, you may see on the internet, oh, lab-free insurance, get your life insurance without an exam. And you could see that all over the internet. I could tell you we work with 25 different insurance companies. If you read the small print, those insurance companies have the right to order an exam. Most insurance companies have lab-free options. It's not guaranteed. Pre-COVID, the only company that we work with, and this is pre-COVID, that guarantees lab-free was SBLI, and they guaranteed it for ages 20 to 50 if you're applying for 500,000 under. So if you're applying for 750,000, you're guaranteed to have an exam. Principal had up to $1 million, where you may be lab-free, Penn Mutual up to $5 million, and Prudential up to $1 million. Lincoln was up to $1 million, so a lot of them had a lab-free track. And the way this works is that there's certain knockout questions, certain prescriptions, maybe family history, but there's also a lot of other questions that have nothing to do with your health. Like if you've ever declared bankruptcy, or if you've had multiple speeding tickets, or if you're not a US citizen. Those types of questions may be knockout questions out of the lab-free process. And even then, the people that are left, the 25-year-olds that are on no medications, they take 10% of those people and take them out as a random, holdout. They take those people out of the lab-free option and they order labs on them as part of their, quote, internal auditing. So again, we have no say who goes through the lab-free option. We like to try for the lab-free, but that is all done. There's knockout questions, and then there's that internal auditing that the insurance company does. So I would say about a third to 50% of the people that actually fit this criteria are actually lucky enough to go through the lab-free option. So when COVID hit, you would think, okay, instead of allowing a third go through the lab-free, maybe we should allow 60% go through lab-free. The insurance companies didn't do that, but what they did do is they expanded their guidelines. So now SBLI guarantees lab-free up to 750,000, and they up their age to age 60. Principal up their amount to 3 million if you were 40 and under, and 2.5 for 41 to 50 if you had a physical with labs in the past 2 years. Because what they're going to do, they're going to order your attending physician statement, which is your medical records, in lieu of having an exam done. Penn Mutual up theirs, Prudential up theirs, Lincoln up theirs as well. So more people did go through the lab-free option by that, not because they let a higher percentage, but by expanding these guidelines, more people did actually go through the lab-free. And interestingly, just like probably all of us, all companies during this pandemic probably had to make business changes, right? Whether it was working remotely, things like that, that you didn't do pre-COVID, that you were kind of forced to do, kind of like insurance companies were kind of forced to do this, right? And then you're saying, oh, this is actually kind of working out okay, so we're going to make it a permanent thing. And that's what the insurance companies are doing. None of these life insurance companies are actually bumping the amount down for or going back to pre-COVID guidelines. They're actually keeping these permanent. Disability insurance companies also up theirs to like 10,000 monthly benefit, where you could be eligible for lab free. So, there have been changes with that during the pandemic for sure. And also when you apply for insurance, they run your name through a prescription database. Now this prescription database shows medications that have been filled in the past 5 years. And they're kind of color coded. So think of a traffic light, green, yellow, red. Okay, a green medication may be something like birth control pill or random antibiotic 2 years ago, something an underwriter's really not going to be concerned about. A yellow medication may be anxiety or depression medication or narcotic. Red medication may be something that you would typically be declined for insurance, like chemotherapy or AIDS treatment. Now, in this prescription database, it shows the name of the medication, the dates that they're filled, the dosing, the name of the doctor that prescribed it, as well as the doctor's specialty. Now, we always tell the clients, they're going to run your name through this prescription database, any prescriptions out there on you. It's amazing how many people don't want to disclose something, and they may be surprised, like, how did you know about Dr. Barlow? Like, I may tell them, hey, they're ordering Dr. Barlow's records, and that's a doctor that wasn't disclosed to us. And the client may say, how did you know about Dr. Barlow? Well, because they ran your name through a prescription database and they see you're currently taking Wellbutrin for depression, which also wasn't disclosed to us, and they see Dr. Barlow has been prescribing that for the past year. So trust me, they find this information out. Just a little tidbit of information, do not ever have a friend or a family member write a prescription for you unless they keep a medical record on you. And your clients that are physicians should never, ever, ever write their own prescriptions. That's a no-no. And these have all been things that have occurred during underwriting, where they go and order medical records and there's no medical records on you. And it turns out that, well, that doctor was a friend of yours who wrote that script. So that can be a challenge during underwriting. And speaking of challenges, the medical record process. We like to call this the bane of our existence here at LLIS. This is by far the longest part of underwriting when insurance companies want to order medical records. And the way this works is if they need to order Dr. Barlow's records, okay, all insurance companies use a third-party vendor such as Exam One to order their medical records, and 99.9% of all doctors use a third-party copy service to handle their medical records. So the way this works is if they want to order Dr. Barlow's records, say Dr. Barlow was my doctor, they would send a request to Exam One. Exam One would send an authorization to Dr. Barlow. This is an authorization I already signed with the application. Dr. Barlow would send that authorization to their copy service. Now, this is not a Kinko's or Staples down the street. This is a third-party vendor that only handles medical records for doctors. And then the copy service will send an invoice. And some of these copy services say, please allow 2 to 20 days to log in the request. So then they'll send an invoice to Exam One because, of course, they want to be paid for this service. So then Exam One will send payment. Some of the copy services accept credit card payments. So that's nice when they accept credit cards, but others only accept checks. So Exam One may need to snail mail a check to them. And then and only then are records sent to Exam One and then sent to the insurance company. So as you can see, there's a lot of moving parts, a lot of places where little hiccups could occur. Some doctors require their own special authorization that may need to be signed that we'll need to send to the client. They'll need to print it out and put a real signature. Those can't be electronically signed because they compare the signature that's in the medical record to what they're signing on that special authorization. And so we need to send that to the doctor's office so that records can be released. So you can imagine all the insurance companies during the pandemic having an increase in business. And some of these copy services in doctor's offices were short-staffed. So you can imagine the backlog that occurred during the pandemic. And just an FYI, all the insurance companies are still behind in trying to catch up. So there are delays that are still occurring with that. But you know, way back when I first started seeing my primary care, I had a paper chart, right? Now my doctor types everything in a laptop. I got a patient portal, and people who have electronic health records like that, that helps the process. A lot of insurance companies are using services such as Human API, where they'll send a link to the client, and the client can link their patient portal with the insurance company. And they can essentially get that information almost immediate instead of waiting the 30 days. But the tricky thing is, it depends, you know, it's not necessarily the full medical records. It depends on what that particular doctor is willing to share through the portal. For instance, here's one, okay? They may, you know, Dr. Smith, okay, they may see that this person has generalized anxiety disorder, and you could see the medical code with that. And then you can also see that there was a 60-minute psychotherapy session. You could see labs were ordered, but you're not seeing the doctor's notes, you know? You're not seeing the lab results. You're just seeing that labs were done. So in this particular situation, this is really not very helpful. You know, they can see, okay, this person's got anxiety, and the prescription database may show that the person's prescribed Xanax or something like that, but you really want to see the doctor's note. So they would probably need to go ahead and order Dr. Smith's full records. But here's another example of an electronic health record. You're seeing the vitals there, right? You're seeing the lab results, whether they're in normal range or not. You're seeing what medications are prescribed. the height and weight. You actually see an EKG there. And it looks like maybe a little PDF where you can actually download that EKG or the report so you can see it. So I feel like this one may be enough information to give you a snapshot of somebody's health, enough to make an offer without having to go and order the full-fledged medical records. And some doctors may share the full-fledged medical records. So it really is, it depends on the particular doctor. And while we're talking about doctors' records, I'd like to explain the difference in medical records, the difference between clinical medicine and insurance medicine, because we may have a client that's approved at preferred instead of preferred plus because of their cholesterol. And then they say, Jenny, if my doctor was concerned about my cholesterol, my doctor's not concerned about my cholesterol. So why is the underwriter? Well, your doctor has the luxury of keeping tabs on your health, and they can change the course of treatment. They can add medications, up dosing, lower dosing as you change your diet or maybe exercise more, whatever the case may be. Okay. But insurance companies don't have that luxury, or the underwriter doesn't. They're taking a snapshot of your health right now and trying to determine, what are the chances that this particular situation could get worse in the next 10 or 20 or 30 years, depending on the length of the policy? They can't change your rates. They're making a determination now. This is the only time they can look at your health. Not only that, if you're applying for $3 million of life insurance, unlike your doctor, the insurance company is on the hook for $3 million. So you better believe they're going to be stricter about your cholesterol than your doctor is. And cholesterol is really a good example because, we ask a lot of questions up front. And, some clients are not always upfront about their health history. And some are, but this is something that can rear its ugly head. And no fault of the client. If somebody asked me right now what my cholesterol level is, I don't know. So sometimes this does cause an approval to be different than what we actually quoted. And insurance companies, they all have different underwriting guidelines and different sweet spots, if you will. So here's an example. The American Heart Association and Quest Diagnostics says your total cholesterol should be under 200, maybe lower than that now. I think they may recently have changed that, but for many years they said it should be under 200. And your total cholesterol over your HDL ratio, which is your good cholesterol, should be under 5.0. Okay, that ratio number, research has shown, is a better indicator of your risk of developing cardiovascular disease, but nonetheless, insurance companies still use both numbers. So company A says, look, we'll give you preferred plus if your total cholesterol is 220, which is slightly elevated, as long as your ratio is 5.0 or lower. You have to fit both criteria, right? Company B says, look, we'll give you preferred plus if your total cholesterol is 300, which is extremely high, but your ratio has to be 4.5 or lower. So if somebody applies for insurance, their total cholesterol is 225 and the ratio is 4.7. They're not eligible for preferred plus with either company because 225 is too high for company A and the 4.7 is too high for company B. So your client Bob applies for insurance with company B and the ratio is 4.7. Now I'm calling them to tell them, hey Bob, you were approved at preferred rates because of your cholesterol ratio. And Bob's saying, well, wait, Jenny, I got my labs in front of me right now, and it says my ratio should be under 5, and my ratio is 4.7. It's totally normal, and it is. However, remember, standard is average life expectancy. So company B is saying, if you want the preferred plus, the cream of the crop approval from us, your ratio not only needs to be normal, but it actually needs to be low. And that's why, every company has their different guidelines. And cholesterol is just one example of many, many where the guidelines differ from company to company. So let's talk about the MIB. And no, I don't mean the Men in Black. I'm talking about the Medical Information Bureau. This is an insurance database that your name goes into whenever you apply for life insurance, disability, long-term care, health insurance. And information is put in this database and it's shared with other insurance companies. And really, there's two purposes of this database. One is to protect against fraud. Say I applied for insurance 6 months ago and I got smoker rates. And remember, smoker rates are 3 times the premium. I'm like, heck no, I'm not placing that policy. That's too expensive. So I quit smoking, and it's 6 months later, I'm going to a different agent and I'm applying with a different insurance company. Well, that second insurance company is going to see that 6 months ago I applied for insurance and I got smoker rates. And in fact, they can see those lab results. They're going to take a look at the application that I just signed now with the second company that says, no, I've never used nicotine or tobacco in any form. So it's protecting the insurance company from people learning the system on how to lie so that they can get the best approval that they can. And yes, it protects the insurance company, but it really protects all the consumers, right? Because who pays for fraud but all of us through our premiums. The second purpose is to make sure somebody isn't overinsured. I need $1 million of life insurance. I mean, we all want a good deal, right? And people want to shop around. And it's a great idea to shop around for quotes. It is not a great idea to submit multiple applications. If I need $1 million of life insurance, if I submit 6 applications, all the underwriters are going to see each other's application. I may not be eligible for $6 million of life insurance. An insurance company, and you may not realize this, but an insurance company that knowingly overinsures a person and it results in their murder for the death proceeds can be found liable for that murder. So no insurance company wants to be put in that situation. There are certain calculations on the amount that you can place. So if a client comes to us and actually has a pending application, we're going to recommend not submitting one with us because we don't want to negatively affect what they have going on with the other agent or the other insurance company. However, if they do get an approval and they're not happy with it, by all means, you can circle back. We can see if we can improve on that offer. Again, we don't want to negatively affect what they have going on. So again, let us be your personal shopper. Shopping for quotes is great, but submitting multiple applications actually negatively affects the underwriting. And then another source of information is the telephone interview. When I know we gather a lot of information from the clients, and the purpose of us gathering that information is so because we work with like 25 different insurance companies, right? In order for us to accurately quote or to even make a recommendation, we need to know about your client's medical history, lifestyle, family history, things like that, right? But that doesn't mean that if they're applying for insurance, especially if they want to go through the lab-free or accelerated process, they need to provide that information directly to the insurance company through a telephone interview with the insurance company or a third-party vendor, or sometimes the insurance company will send a link to them, kind of like we do with our questionnaire, and they can complete their health information online. So they are providing this information again during the underwriting process. And there's other databases as well, but those are the main ones. So let's talk about financial underwriting. For your younger clients, typically the purpose of insurance is income replacement. So there is a certain calculation, like I said, based upon the client's age and their income. Somebody who makes $25,000 a year cannot apply for $20 million of life insurance. They would be worth more dead than alive. And no insurance company wants to be put in that situation. Now, for your clients that are homemakers that are not technically bringing an income home, they can apply for up to $1 million as long as the spouse has that amount of coverage as well. And if the purpose is estate protection, there's questions about the client's net worth and the estimated estate taxes that need to be paid. If the purpose is business, like a buy-sell, there's a lot of questions about the value of the business and how much percentage that client owns of the business. So there's certain calculations like that. They want to make sure the client's not overinsured. For disability insurance, the amount somebody's eligible for is based upon their income. So we do need to submit taxes and pay stubs and W-2s. So there definitely is financial underwriting for these products. So let's talk about family history. Now, usually they're only concerned about parents and siblings with a history of or death of heart disease, cancer, kidney disease, diabetes, or stroke prior to age 60 or 65. So they're really not concerned about grandparents or aunts and uncles. It's really parents and siblings. Long-term care is very concerned about parents who have a history of Alzheimer's. It can actually affect the amount you can apply for or whether you can even get long-term care insurance if you have a parent with Alzheimer's. So we've talked about the 4 areas, lifestyle, medical history, financial, and family history. So let's go into technology and underwriting. When I started working here at LLIS 13 years ago, all companies had clients go through full underwriting. I don't care if you were 25 years old and you were applying for $100,000 of life insurance. You had an exam done. Everybody had an exam done. They didn't necessarily order medical records, but you definitely had an exam done. And about 5 or 6 years ago, some companies were starting to roll out an accelerated process where an underwriter will determine whether to order labs or medical records based upon criteria that the insurance company sets. Now, with advancements in technology, now a few companies have an automated underwriting where a computer actually makes the decision. So let's kind of take a look at these differences. Full underwriting, they're going to review all the information that we just went into detail, the application, exam, medical records, and all the databases. And there's different databases, additional databases that they run your name through too. But let's go into accelerated underwriting. When somebody wants to go through accelerated underwriting, and we try for this whenever we can, because why, if somebody has an option or a possibility of being approved quicker than 2 to 3 months, geez, why not go for that, right? So basically the way this works is we submit a ticket. So very basic information about the client. Again, they're going to need to do a phone interview with the insurance company, or the insurance company will send a link to them and the client can complete the information online. As they're completing that information, their name's being run through the prescription database, the MIB, their motor vehicle reports being ordered, medical claims, consumer reports. So all these, um, their name are being run through all these databases. And then once they get that, the underwriter is going to review that information, determine which path. If they say, geez, we have enough information here to make an offer, there will be no exam or attending physician or medical records ordered. So they can go through the accelerated process and get an approval in a day or so. Say the person has prediabetes or something like that. The underwriter may say, or some other knockout questions, they may want to order an exam and or order medical records. So they will be knocked out of the accelerated process and pretty much go through full underwriting. So let's talk about automated underwriting. Starts out exactly the same way. We have no idea whether it's going to be, accelerated versus automated. And they just rolled this out this past year. So again, we submit the ticket. They're either going to do the phone interview or e-interview. There's names run through these databases, and then a computer determines the offer. No underwriters involved in this. So it's pretty much instant approval. In this day and age where people like things immediate, it could be great, right? There's definitely pros and cons. So let's talk about the pros and cons of it. And this is just of automation where the computer makes the approval. Okay, you get a quick approval. This day and age where people want something immediate, that's great. Who wants to wait 2 to 3 months when you can get your insurance like immediately? It may actually be better than quoted. Sometimes we do have that, and it can be consistent underwriting. No human error, right? It's done on an algorithm. So it's more consistent, the insurance company says. Less requirements for the insurance company to pay for, because they're not paying for medical records, they're not paying for an exam, they're not even paying for an underwriter to review anything. But it's also less requirements for the client, no exam that they have to go through, and less time, right? And it allows underwriters to focus on more complicated cases. Sounds wonderful. And it is wonderful if everybody were approved at Preferred Plus. If I could guarantee that, then I would be all for this automation. So let's talk about some of the cons. The approvals may be worse than quoted. And when that does happen, sometimes it's difficult to get the details of the reason for the approval. What we're being told now is, oh, somebody's approved at standard instead of Preferred Plus due to prescription and medical claims database. Well, that doesn't really tell us much. How do we call a client and tell them that? Of course, they're going to say, well, what prescriptions, what medical claims, what really triggered this? And we don't have exact answers to that. So that can make it challenging. And sometimes they don't tell us details of that. They say the client needs to order their consumer report. Now, the good thing about this is that at least when we give the client the number to call, typically they get their report in a day or so. So it's not like they're waiting a long time. And if the client's willing to give us that report, we can help decipher maybe what's in there that triggered the approval, or we can go back to the insurance company and say, look, it's not like you're disclosing any private information. We have the report here. We're just trying to figure out what triggered the approval, So that can be helpful when the client's willing to make that call and give us the consumer report. They're helping us help them, right? And then also nowadays, approvals are kind of based upon a score. The other con I kind of feel like right now is that, yeah, it may be consistent underwriting, that they're saying, the insurance company is saying is a good thing. But the tricky thing is, and I just want to give an example. Say I'm taking Xanax for anxiety every single day, okay? But my boss, Mark Maurer, he's taking it 4 times a year when he gets on a plane because he gets anxious flying, right? Is that computer saying, oh, there's a prescription for Xanax, so we're going to approve at standard rates? Or where an underwriter could say, wait, Mark only gets his filled once a year. And we can explain that to an underwriter. He only takes it 4 times a year. That maybe Mark should be approved better than me. You know, I have generalized anxiety and take this medication daily. And maybe instead it's standard, I'm fine with my standard approval, but maybe he should be standard plus or even a preferred possibly. So, you know, that's where sometimes having a trained underwriter's eye that can make those determinations, you know, can be good, where you kind of lose that maybe with automation. And again, like I said, approvals are based upon a score now. So let's go over an example. See, back in the day, and when I say back in the day, I'm talking 6 months ago or a year ago. We're not talking a long time ago. So back in the day, they used to take the worst case scenario and underwrite for that. In other words, if somebody had diabetes and high cholesterol, an underwriter didn't really care about that high cholesterol because the diabetes was a much more severe condition. That trumped the cholesterol, right? So they only looked at the diabetes. Now they're looking at multiple things. So for instance, say you had a client that had slightly elevated blood pressure and was on blood pressure medication, but maybe that level was still eligible for Preferred Plus according to a particular company's guidelines, right? Cholesterol, slightly elevated, right? But again, maybe eligible for Preferred Plus. Nobody cares about one speeding ticket. And maybe a person slightly overweight, but again, eligible for Preferred Plus. So back in the day, because these all fit in Preferred Plus categories, the person would be approved at Preferred Plus. Now they're saying there's 6 dings against that person. So instead of Preferred Plus, that person's approved at Preferred or Standard Plus. So they're looking at kind of co-mortality, right? And, you know, I'm a trained underwriter myself, so I kind of get it that especially blood pressure, cholesterol, and being slightly overweight, all 3 of those are risk factors of developing cardiovascular disease. Having all 3 of those, maybe they shouldn't be eligible for Preferred Plus. I get it. You know, maybe if they only had one of them, they would be approved at Preferred Plus. But because they have several, they're being approved at a different classification. And I totally understand it from that perspective. It just makes it a little challenging sometimes when it comes to quoting when their guidelines are saying that they fit in the Preferred Plus category. Here's another example. This was a case study. We actually had somebody who has diabetes, was on medication. They were slightly overweight and had an abnormal EKG. We did not know about the abnormal EKG. And the diabetes, they weren't on insulin. They were on oral medication, metformin, for the diabetes. So we knew about that. We quoted Table B, not Table D. But here's the breakdown. The underwriter said Table B for the abnormal EKG, and then they tacked on 2 additional table ratings for the diabetes and build. So again, instead of taking a look, like which is worse, the EKG or diabetes, and then just underwrite for that, no, they're adding on. So again, it makes it challenging at times. So, you know, this is where the whole industry is going. Every single insurance company is starting to do this now. And you know, we'll see where the future leads with this. But so let's talk about the future. Of course, I don't have a crystal ball, but some of the things that are happening, the lab-free options, the expanded guidelines, they're looking to keep permanent, so I think that's good. They're trying to work more with electronic health records, which is, the medical record process is the longest part. So, anything they can do to help that process, that's great. They're actually starting to use dental records now. The problem with some of the lab-free, people can try to work the system or lie about not smoking, but people tend to be more honest with their dentist, or their dentist can actually tell if they're a smoker based upon stains and things. So they're going after dental records now as another source of information to see about smokers. They're also, instead of just getting medical records, they have contracts with Quest Diagnostics and LabCorp, where somebody who has diabetes, really what they want to know is it controlled? So they want to see the labs. They don't need all the doctor's notes. So if the labs can give them the records quicker, they'll go that route. And then there's the wearable devices. We all have Fitbits, Apple Watches, our phone that we're tracking our meals, our exercise, our weight loss, our stress, our sleep. I know that this can be controversial, but some insurance companies, whether it's during the underwriting, whether we can submit that information to maybe bump us up to a better approval. As far as like having healthy lifestyle credits, I'm putting that in air quotes, to maybe just bump us up to one class better for our approval, or whether they can track us during the life of the policy, the 10 years or 20 years. And, people may say, well, I don't want them tracking me, the whole privacy thing. But when all's said and done, really what life insurance companies in particular, their goal is to make sure that you don't die, right? They don't want to pay a death claim. So it could be a win-win situation where if they see you're stressed or you're gaining weight, maybe they could send you a free membership to Weight Watchers or a massage or things like that to help your health, because they don't want you dying, because they don't want to pay that $1 million out, right? Already in the property casualty, the safe driving record, they're tracking people's driving, giving them lower premiums or whatever with that. Now, as a whole, insurance companies aren't doing this yet, but there is some talk. So I wouldn't be surprised if we start seeing that in the next couple years, where insurance companies may be using wearable devices as a source of information. Now, what are things that you can do to help your client through this process? Because we look at financial advisors as being, part of our team with the clients. The first thing is just keep in mind, standard rates is average life expectancy. That's what most people are approved at. I know our goal is to all get that preferred plus, but very few people are eligible for that. So if you keep that in mind, that standard is what most people get, then that would be good. Again, honesty is always the best policy. Our quotes and our recommendations are only as good as the information given to us. There's so much information out there. Trust me, they are going to find it about the client if they could just be upfront, because I can't tell you how many times we find things during underwriting that it's like, if we'd known that, we would have recommended a different company, because again, they have different guidelines. So, don't submit multiple life applications at the same time. It negatively affects the underwriting. Let us be your personal shopper. And again, the realistic expectation that the traditional process is 2 to 3 months. We try for accelerated, but we set the expectation that it takes 2 to 3 months. If a client expects it to go through accelerated, then they're just going to be super frustrated when they go through the traditional process. So setting up that expectation of 2 to 3 months is helpful. And then they're super happy if they go through the accelerated process. Any questions? Let me see what we have here. Somebody asked, does Lincoln still offer lab free up to $1 million? Lincoln actually upped theirs to 2.5, but again, it's not guaranteed. It's a possibility. There are knockout questions, and about a third of the people actually go through it. And this automation is so new in so many industries that just, I'm sure in the next 2 months, I could probably do a whole nother talk on this and the changes in that. We are seeing changes weekly with different insurance companies on how they're processing business. And so it should be interesting to see how things, go, whether it's they even allow paper applications or, you know, whatever. Well, I don't see any other questions come in. I thank you for your time. I appreciate it if you could complete the survey, and you have my name and email. So if you have any questions that you think of afterwards, feel free to reach out to me directly. I'm more than happy to answer any questions for you. Thank you and have a great evening.